Good morning, traders. Richard here, bringing you another review of the MAG7 stocks using artificial intelligence. In the last update, we were updating trading stop loss levels, and we'll take a look if there's been any new signals in the MAG7 stocks using the Fulgent AI engine that sits on the Metastock platform. First up is Apple. We've had some really great moves in Apple, 19% move after that volatility breakout signal there. I'll just discuss the most recent ones. We also had the cloud chart rebound buy there, and the cloud support rebound buy there. We now had to move the trailing stop loss up to 288. So watch out for climatic price action. It's a good thing that Apple broke out of this double bottom base. So it's now what we call going up in the staircase, so to speak. And just keep those trailing stops as it moves higher. Next up is Amazon, also a very strong performer there, volatility breakout signal there, as well as the cloud chart rebound buy signal there, 34 and 35% respectively. Got a little bit extended, both Apple and Amazon's a bit extended from the top end of the cloud. So yeah, is the trailing stop as generated by Fulgent AI engine at 253, so keep that in mind. You just want to be slightly below that 23% Fibonacci retracement, and just don't want to get stopped out there unnecessary. So the trailing stop loss there on Amazon is 253. So watching very closely how that one's performing. Google is up next. A beautiful move there. That was a 42% and 47% move. Volatility breakout signals there. There were a few other Ichimoku cloud chart buy signals, but we'll focus just on the volatility breakout signal for Google. Now the trailing stop loss is up at this level here at 371.9 is the new trailing stop for Google. Next up is Meta, bit of a problem child here. We had a great volatility breakout trades there. Hit the Ichimoku cloud chart resistance level, expected it to pull back. It snapped back, did a 50% Fibonacci retracement, and is back within the support zone. So the bottom end of the Ichimoku cloud is a support zone. So this volatility breakout signal is still active. The trading stop is there at 567. But ideally, you'd like to see Meta to break quite clear of the top end of the Ichimoku cloud. That will be another buy signal there when it crosses the cloud to the upside. So watch out very closely to see if this support level is going to hold here at 519, and then we can have a continued rally from there to break past the top end of the Ichimoku cloud. So we're not out the woods yet with Meta. It's got a lot of work to do. Microsoft, similar, another problem child one, had two beautiful signals there, ran into trouble there at the top end of the Ichimoku cloud chart resistance, snapback, volatility breakout signal there. Also similar situation, needs to really break past the top end of the Ichimoku cloud to be ultra bullish, but that volatility breakout signal is still active with the trailing stop here at 380. Ideally, you'd like to see it to break free from this cloud chart resistance. Remember, Ichimoku cloud's price action above the cloud is bullish, price action below the cloud is bearish. But so while it's still digging into the cloud chart resistance, it looks like it wants to break out past that top end cloud chart resistance zone. NVDA is next up. Beautiful move there, 36, 40, 22 and 13% with a late stage volatility breakout signal there. We've got the trailing stop loss there at 208 for this move. It took a long time to break out of this base. I've been accumulating every time it got to between the 165 and 175 zone. That's been accumulation zone. So there's plenty of other trades that are not really AI generated trades, but Ichimoku cloud chart rebound trades. So we had plenty of, we've got a lot of positions open in NVIDIA based on this support rebound buys at the bottom end of the support zone. But volatility breakout signal worked well. There's a few intraday, if you go into a 4-hour chart, there's a few other volatility breakout signals that would have kept you on the right side of this trend all the way up there. So fantastic performance for NVIDIA. Next up is Tesla, struggling a little bit here. Two volatility breakout signals there. Strong move up and then ran into trouble at the bottom end of the Ichimoku cloud. Snap back, cloud chart support rebound buy there, 19 and 15%, and now it's struggling with this resistance zone here with the upside resistance target, the top end of the cloud. That's if this resistance, if we break past this resistance, the next upside target is 462, and then these old highs are the ultimate upside targets, so to speak there. So these are the upside targets if we can manage to break past this Ichimoku cloud chart resistance. So ideally, I'd like to see another volatility breakout signal on this one, but the trailing stop is right about here. We just look at these trailing stops here. Could have one right just below that low there at 422 for that one. Right, let's take a look at the StarMine rankings, where we delve deep into the fundamentals, well, on a quantitative basis, and we look at Apple here. StarMine models. This is a beautiful picture, bullish on the price momentum score. StarMine looks at the it's kind of a price momentum score, basically. Look at various time frames here, and is this positive price momentum, high per star rankings in the price momentum score tends to lead to higher performance there. So that's kind of the point I'm trying to make. Analyst revision score, where we look at the analyst revisions, are they increasing estimates forward, price targets, etc., etc. But not only all analysts, we look at the smartest, most consistently accurate analyst in that ARM score. So we look at the highest quality, most accurate analyst, and we look at that number. So that's a per star ranking 75, so it's in the green zone. Ideally, you'd like to see that higher, but analysts are pulling up the numbers. Short interest, very low short interest ratio there, 96 per star ranking, so that's green. Earnings quality rank is 84 per star ranking. It's in the top 30% of the market overall, but ideally, you'd like to see that much higher in the 90s to 100 score there. Credit risk, smart risk, structural, text mining credit risk, all the so the financial side of, from a credit perspective of Apple is still good. M&A target model, not applicable in this case, as to expect this company's just too large for that. Insiders are still selling, so the insider per star ranking system is bottom 16% of the market on a global basis, so there are some insider selling taking place, which is an area of concern. Relative valuation and intrinsic valuation is the bottom 20% of the market, so it's not a cheap stock. As you can see, the global rankings here, where Apple ranks in terms of all these valuation models, you can see that it is not a cheap stock at this point in time on a relative valuation basis. Next up is NVDA. Fantastic bullish models there for the StarMine. Price momentum score very good. Analyst revision scores high. Smart holdings, where we track the most, the smart money, where smart money rank is per star rank of 76, so it's in the top 30% of the market. So the smart money is still accumulating the stock, all those top performing institutions and fund managers that we track, and we look at what are they buying, and NVIDIA is one of those that they are accumulating on a consistent basis. Short interest is not really applying anymore. There's not a lot there's not a lot of short interest in the stock. Earnings quality is in the top 20% of the market, 82 per star ranking. Credit risk, there's also green there, not much to worry about in terms of credit. Combined alpha model is where we combined all the StarMine rankings. You can see a lot of the rankings go into the combined alpha model, and that's the top, 75 per star rank is the top 30% of the market, so we should see some outperformance coming through on NVIDIA. The only problem there is intrinsic valuation, relative valuation. Insiders are still selling by the hordes, and the M&A target model, so it's too large for a takeover, so we can kind of ignore that ranking. But the intrinsic valuation, relative valuation score, that is still in the bottom 20 to 30% of the market, so that's not particularly good. So it is an expensive stock based on the relative valuation basis, but on an absolute terms, the bullish case here, absolute terms there, it's looking really, really good. NVIDIA, so keep that one in mind. Meta, kind of a mixed bag in all the StarMine models. Earnings quality is very poor. There's a bottom is in the top 60% of the market, but that can be better. So it's not a high quality business model at this stage. So Zuckerberg will have to do a lot more with Meta to improve the earnings quality. Now, if we look at earnings quality, we delve deep into the balance sheets and income statement to look at the growth drivers. And how does that predict the consistency of the earnings growth in future? So Meta needs a lot of work on that basis. Combined alpha model also not particularly interesting. Valuation momentum scores very low. Price momentum scores also quite low in the bottom 30% of the market. At least the analysts are becoming more bullish on it. The ARM score, the analyst revision score is moving higher, and that's in the top 30% of the market, so it's slightly green. It can be better. And also some of the more, the smart money is starting to accumulate the stock, as well as the short interest are moving lower. Not much movement on the insider side of things there. Credit risk, a little bit of financial risk there, as we've now highlighted with the data center financing, etc. So we've picked that up there in the credit risk ranking. But so far, not an eye-catching ranking from the StarMine's model perspective. So Meta has got a lot of work to do before it's really an exceptional business, particularly on the earnings quality rank. That's basically a very poor earnings quality rank. Microsoft, similar situation there. Analysts, revisions, analysts are pulling up there, improving their numbers. Smart holdings, are there smart money in the stock? Yes, there are some smart money. Some of the best performing fund managers are accumulating the stock. Short interest is very low. Personal ranking 96. Credit risk, structural, text mining, and combined alpha model, very favorable ranking there. So we do like Microsoft on the basis of the StarMine rankings. Just once again, relative valuation is a bottom 20%, 30% of the market, basically. Insider selling is also in the bottom 20% of the market, basically. So there is some risk factors in that. Earnings quality, also similar to Meta, needs to improve the earnings quality of the income statement, balance sheet, and the growth drivers within those earnings quality analysis there. So there is some problem there, as well as some insider selling on Microsoft. So lots of room for improvement for Microsoft, for example, looking at these various models. Tesla is another one with a problem there on the earnings quality side of things. Very poor earnings quality rank there, similar to Meta. Credit risk combines improving, but there's smart ratios, like structural and text mining credit risk there. So there is a bit of credit risk on the on Tesla's side. Combined alpha model, bottom 20% of the market in terms of valuation. Valuation momentum is a bottom 3% rank. It's not a very good ranking. Price momentum scores in bottom 20% of the market, and the analyst revision scores 37. So the analysts aren't particularly interested or pulling up the numbers or improving the earnings estimates in Tesla. So that can be problematic. As soon as that starts to come through, we should start seeing some improvements in Tesla. But intrinsic valuation, bottom 1% of the market. Relative valuation, bottom 5% of the market. So it's some of the worst rankings here on a valuation basis. So frightfully expensive stock, poor quality earnings, so highly speculative trade. You're basically a call option on future technology, robotics, self-driving, etc. But as for the financials and stuff, it's not a pretty picture on that side. Now, next up is Google StarMine ranking. Beautiful rankings. This is what you would like to see if Tesla can only be something like this. Price momentum score 90, per star ranking 96. Analyst revision scores looking good. Smart holdings, the smartest smart money is accumulating the stock. Short interest is low. Credit risk is very low. These per star rankings very high, gives you nice green rankings there. Intrinsic valuation remains a problem here. It's a very expensive stock on a relative valuation basis. Look at the global rankings. And relative value there, intrinsic value, it's all on the bottom 20% of the market. Earnings quality, once again 55, so they can also improve on their earnings there. So similar to Meta and Tesla, they need to do a lot of work on improving the earnings drivers when we deep dive into the income statement and balance sheet and do a real Buffett style analysis of these companies. That's where we stand with that particular ranking. So combined alpha model 70, just starting to look in the green side, not there yet, but nevertheless there is room for improvement there. Price momentum scores very high, valuation momentum scores a bit on the low side there, but that should starting to improve when the earnings quality improve, as well as price momentum combined alpha model improves there. Smart holdings 80 there. The smart money is still accumulating the stock. Short interest is very low. Insider selling is neither nor anything particularly interesting there. But overall, a relative valuation, it's a very expensive stock, but yet again, it's a very high quality business. But the earnings quality can improve there, so monitoring that particular rankings factor very closely. But overall, lots of bullish scores, more bullish than bearish scores for Google. Amazon, another one. Bullish analyst revision scores, high ARM scores, 94 per star ranking, so the analysts are taking up their numbers, improving on that. Smart holdings, the smart money is accumulating the stock. The per star ranking there is 90, is in the top 10% of the market. Short interest is 97, so there's not much short interest involved in it. Credit risk and text mining risk there that's quite low. There's the bottom, it's the top 20% of the market and the top 30% of the market there. The earnings quality here is 15. So let's look at the bearish case. Earnings quality is very, very poor. So Amazon's got a lot of work to do in terms of cleaning up the balance sheet, cleaning up the earnings drivers for future revenue. So they've got a lot of work to do there. You can see smart ratios, credit risk, highlighting some risk there, structural credit risk, highlighting some risk there on the credit side. So you might want to look at that balance sheet a little bit more detail, do a real Buffett style analysis of Amazon before piling in. Nevertheless, price momentum score is 28. It's not looking too favorable. It's the bottom 30% of the market, but at least the analysts are improving their numbers, upgrading their numbers. So we should start seeing the price momentum score moving higher as the stock price starts to move in the direction of the upgrades, etc. Intrinsic valuation, bottom 20% of the market, and relative valuation, bottom 30% of the market, so it's not a particularly attractive stock on a relative valuation basis. Short interest is very low. Insider selling is still quite high, but there is some, the smart money is still accumulating the stock. So not the best kind of rankings you're looking for, but I'm particularly concerned about the poor quality earnings quality rank there. So Amazon's got a lot of work to do before it's a high quality business as such. Gee, now that was quite a lot we covered, but once again, just the ones, just keep in mind the StarMine rankings. The bullish, you will want to see a more bullish rankings than bearish rankings, but this is a really deep dive into the quantitative fundamentals of each stock, and it's quite worthwhile looking at a stock from that way so you know where the risk factors are. But Apple and NVDA are still looking really good on these rankings. Right, back to the stocks, just to recap, just keep a close eye on those trailing stop loss for each level. There once again 208 for NVIDIA, Microsoft, looking at the bottom of the cloud, yeah, that one there at 380, Meta, bottom one there at 567, Google trailing stop there, once again it's 371, Amazon trailing stop there is right there at 253, and then Apple's trailing stop is right up here at 288. Until next time, thank you for watching. Happy artificial intelligence trading. Bye for now.